statistical trading techniques included in the StatWare library available through NinjaTrader, and the subject of this webinar. In 1997, she won the Market Technicians Association's Best of the Best Award for her work in momentum, and this year became the first American and third woman worldwide to be awarded with the International Federation of Technical Analysis MFTA diploma. Dean Rogers, which is co-hosting this event, is the general manager of the Kase call center in Albuquerque, New Mexico, and handles the day-to-day operations for Kase. He has worked with Ms. Kase as her right-hand man for nearly 8 years, and she has been teaching StatWare to traders for 6 of those years. With that being said, I'm going to go ahead and turn off my mic and leave the floor open for Cynthia Kase. Thanks very much, everyone, and enjoy the presentation. Bye-bye now.
Well, good afternoon, everybody. Looks like we have a nearly full house here. I guess you can see what slide I'm on slide 2, overview of the webinar. And what I want to say is the way that we organized the webinar is to break it up into 2 aspects. The first is, what is the mathematical, technical, or statistical concept or idea behind the indicator? Most of you may have heard, as my introduction went forth, that I'm educated as an engineer. I worked for 10 years as an engineer, and when I became an oil trader, I really took to technical analysis because it appealed to my numerical personality. I developed the Kase StatWare not as something that I was going to market, but I actually developed StatWare while I was still a trader, and I did it just to help my own trade. I studied the existing indicators and really felt that there were ways to improve existing indicators. So that's what I did. So I'm going to share with you the philosophical, or if you will, engineering basis behind the indicators. And also, as a preface, will say that my indicators, for the most part, are used in a similar way to traditional indicators. The big difference is that they're more rigorous mathematically, and therefore they do what they're supposed to do better. As an overview, we're going to talk about the entry system, the momentum indicators, the exit system, combining the whole thing together, and then we'll go through some sample trades. One of the key concepts that spans the entire presentation and underlies my entire way of thinking is Pareto's Law, otherwise known as the 80-20 rule. And what I say is that you can capture 80% of what an indicator does with 20% of the code, coding 20% about it. And therefore, if the mind has the capability of understanding 100% of something, you can have 5 indicators, each valued at 80%, so you can quadruple the information that you intellectually process through the use of computerization and, in a sense, condensing the information into more manageable pieces through the use of the computer. So that's the overall concept that underlie a lot of my indicators. The first system that we're going to take a look at is my entry system. And the entry system is really a very simple system in that it uses momentum crossovers. It uses RSI, MACD, and stochastic crossovers. The big thing that's different is that we have a unique, longer-term permission filter. That is, we have a filter that acts in a higher time frame and has some unique characteristics that we will review as we go forward that speed it up and make it more sensitive than a regular higher time frame filter. And then also we look at specific bar and close patterns. The way that we speed up the higher time frame filter is through the use of something called synthetic bars. And again, what I'm going to do here is I'm going to introduce the technical concept because there are 2 types of technical traders. There are those who want to understand how everything works and what all the theory is behind the indicators, and the second kind that only want to know how to use them. So hopefully we'll satisfy both with this presentation. I'm going to go through the philosophical background, and then Dean will go through how to use them. For example, if you're going to filter a daily chart, you might use a weekly chart. If you're going to filter a 5-minute chart, you might use a 25-minute chart. The problem with that is, if you're using a 5-minute chart, you theoretically have to wait an additional 20 minutes to get a filter from the 25-minute time frame filter. The way that we overcome this is to use a 5-bar, or how many ever higher time synthetic bar. So instead of, for example, filtering a day with a week, we filter a day with a moving 5-day filter where the week always ends today. So there's never any lag in waiting for a signal. And on the left, you can see that the way that this is done is you use the open of the first of 5 bars, the high of 5 bars, the low of 5 bars, and then the close of the 5th bar, or bar 0. And that's at time x, and if you look at time x plus 1, we drop off the first bar and add a new bar, and now your higher time frame filter is the open of the first bar, the new high, the low of the 5 bars, and then the new close. So we have higher time frame filters that use these synthetic bars.
Okay, so here is an example of the case permission stochastic versus a weekly slow stochastic. The case permission stochastic is on the daily chart. It uses a time frame that's synthetically 5 times higher. So if we're looking at a daily, it's building a weekly chart synthetically. We can see that the stochastic, the case permission stochastic, is on top. We have what's called the permission K, which is the purple line, and the permission D, which is the black line. And then on the bottom we have the slow stochastic with the percent K as the green line and the percent D as the yellow line. The crossover that takes place on the case permission stochastic takes place on July 26th on the daily chart, and on the weekly stochastic is taking place just a day later. So what this shows is that the crossover using the synthetic higher time frame is occurring about the same time as it would on a chart that's 5 times greater, the weekly chart in this case. We can see another example off to the right where the permission K, the purple line, crosses above the permission D to give long permission, and shows that the crossover took place at the same time as in this case, at the same time as the weekly slow stochastic. The market then trades higher, and then on November 12th, there was a short crossover, so short permissions. On November 12th, this occurred 4 days before the weekly stochastic crossover took place, which was on November 16th. And then by the end of this chart, November 21st, the case permission stochastic was beginning to cross over long again before the weekly stochastic did.
Yes, so the point is that with a moving 5-time window, it on average it happens faster, so you get a faster signal.
Correct. There's also some filtering rules that we'll look at in just a moment. Well, these are the rules here, but we'll look at the application of these rules in just a moment in the Kase Easy Entry System. But using the case permission screen, very simple rules. If the permission K and the D are near the top, very close, like we can see here on the left of the chart with the circled number 1, it gives a permission, in this case short, when the crossover takes place. If the permission K is quickly falling or rising out of an overbought or oversold condition, then you get and the crossover occurs, you'll get a permission long or short. So on the right of the screen, we can see a number 2, and there's a permission short there as it comes out of an overbought territory above the 85% area. It's coming down very quickly. And then the third case, if both the permission K and the permission are either below 85 and they're above 15 nor oversold, when the permission K is below the D, it's permission short. If the permission K is above the D, it's permission long. This next chart on slide 7 shows, let me go ahead and go back here. This next chart on slide 7 shows the permission stochastic and another indicator called the Kase permission screen. The permission screen actually shows long permissions when it's blue and short permissions when it's pink or the magenta color. What this is used for, the actual Kase permission screen and permission stochastic are built into the Kase Easy Entry System, but if there are users out there that didn't necessarily want to use the Kase Easy Entry System, but they did like the idea of using a higher time frame filter built by synthetic bars, they could very simply add this Kase permission screen to their chart and see that there's a longer term permission long when it's blue or permission short when it's red. With that, I'll turn it back over to Ms. Kase.
Basically, the KEES, Kase Easy Entry System, takes the permission stochastic, so we know whether or not we have permission to go long or permission to go short. Somebody just asked what time frames it works on. Really, it works on everything except a one-tick chart. We've never tried it on a one-tick chart. But if you have a bar with an open, high, low, close, you can use it on the bar. So you might want to use it, on a 5-tick or higher chart, 1 minute or higher, in a liquid market. In any case, you have a situation where you can have your momentum crossovers, either long or short. For example, if the MACD crosses above the 0 line, it's a long. If it crosses below the 0 line, it's a short. If the RSI crosses above its own average, it's a long. Below its own average, it's a short. K above D is long. K below D is short on the stochastic. You've got those short-term momentum crossovers filtered by the Kase permission screen. So we have one of 3 situations when your crossovers are to the long side. You can have the crossovers long and the permission long. You can have the crossovers long and the permission ambiguous, and you can have the crossovers long and the permission short. In case 1, first class long, all you need to go long are the crossover is a rising bar. Is a rising bar where the low is higher than the previous low and the close is higher than the open. That's all you need to go long when your momentum indicators are long and your permission is long. If your momentum indicators are long and your permission is ambiguous, then we want to have a rising bar, 2 rising bars. And to make it clear, it's the second bar that has to meet the criteria for rising bar. So in case 2, the permission was ambiguous, so you needed 2 rising bars. In a situation where you have the momentum long, but the permission is still short, you need the 3 rising bars, as shown with the 3, to get a signal. Now, before everybody gets overloaded and trying to remember all this stuff, basically on the system, all you have to do is look at the color of the bar and the number, because our system will automatically color the bar with the right color dot and give you the number. And the short, as you'll see on the next page, is just exactly the inverse of the long. You've got the momentum crossovers to the downside, short. First class is that the permission is short. Second class, ambiguous. And third class, the permission is still long. The only other thing that we recommend for the entry, aside from getting the number, you have a signal that's labeled 1, 2, or 3, it's either red or blue, is that we usually wait for a second confirming signal in the direction of the trend. It's a very simple concept in that almost all wave formations, either a 5-wave or 3-wave formations. So if you have an ABC formation, wave C holds the bottom of wave A, and if you have a 5-wave pattern, wave 3, of course, is going to hold the bottom of wave 1. So what we do is we wait for a signal, wait through a pullback, and then take the second signal. In the upper left, we have a good long signal. In the upper right, the second signal was not valid because the pullback broke below the origin of the low of the first signal. In the lower left, we have a good second signal because the pullback did not go above the high of the first signal. And of course, on the lower right, an invalid second signal because it broke the high of the first signal.
So I'll show an example here. Here we have the euro to US dollar forex on the daily chart with the Kase Easy Entry System. This is actually how the entry
You
system
might want to use
works.
the cursor.
Okay. We have the Kase Easy Entry System here. Let me just make sure I have my cursor. Actually, I'll go ahead and get this. This is the Kase Easy Entry System, and this is the way that it looks on the screen. I know that it may be a little bit hard to see here because it's not zoomed in enough, but each of those bars is color-coded as far as the first, second, and third class buy and sell signals for classifications of bars like we showed previously in the last couple slides. Once a third class signal is drawn, if it's a short signal, it's a red number 3 below the bars. If it's a long signal, it's going to be a blue number above the bars. So for example, here the market's falling, a third class signal forms with the red number 3. That's our first sell signal. We then wait for the pullback, as Ms. Kase just described. As long as the pullback holds the previous swing high, which would have been up in this area, that's still a valid sell. During that pullback, we did get a first buy, but we're looking short right now. The pullback does hold the previous swing high. The market begins to fall again, and we get a second signal. Once the second signal forms, it's another third-class signal. Then we go ahead and take the short trade. Market declines from there. Then at this low here, we most likely would have had some sort of exit, momentum indication, divergence, telling us that the market was going to turn. Market starts to come up. We get a first sell signal. But as soon as the high that preceded the sell signal is taken out by this bar, that is no longer a valid sell signal. We are no longer looking to get short. The market then rises. We get a third-class buy signal. We're now looking to get long. We want a pullback that holds the previous swing low, where my red dot is right now. And then we get a second sell signal. As soon as that, or excuse me, we get a first sell signal. That first sell signal occurs during the pullback. But before we get the second sell signal, we get a second buy signal. When that second buy signal forms, we would have gone long, and the market proceeds to go higher from there. Any other signals coming after the second buy signal are also called second signals or consecutive signals. And if the second signal was missed, then you can also take the consecutive signals as entries. We'll look at another example here. This one on the S&P E-mini, S&P 500 E-mini, daily chart again with the Kase Easy Entry System. In this case, the market is rising. A first buy signal forms, then a second buy signal. This is another third-class signal. But between those two signals, there was no pullback. So we don't take the trade on that second buy signal. Instead, we wait for the pullback, which holds the previous swing low. We get a second signal. This one is a first-class signal. And then we go ahead and go long. Now I'm going to take a second to make a point here. The order of the numbers, it doesn't have to be a 1 followed by a 2 or a 1 followed by a 3. It could be a 3 followed by a 1 or a 3 followed by a 2. There is and so we take any of those signals in any order. A third-class signal is not necessarily any less important than a first-class signal. A first-class signal has the underlying permissions and the momentum crossovers. Everything's in one direction, whereas the third-class signal has the bar formation. It took 3 rising bars or 3 falling bars to form. The market is then falling. We took the second buy signal, got long. The market then falls. We get a first sell signal. But before we get a second sell signal, the previous swing high, which would have been where my dot is taken out by this bar, where my dot is now. So this is no longer a valid sell signal. The market continues higher, same thing. You get a first sell signal, move higher to take out the previous swing high, so we're no longer getting short, looking short. The market begins to fall, you get a third class sell signal, and then a pullback. Now, the pullback is discretionary. Well, one, the pullback is discretionary, and two, the size of the pullback is also discretionary. Obviously, on an intraday chart, this would have most likely been a pullback. So we have a pullback here, then a decline lower, or a decline to give us a third class signal, which is our second signal, and then we get short. Go ahead and turn it back over to Ms. Kase.
I was just typing a message. Basically, when Dean says that the pullback is discretionary, he doesn't mean whether or not to wait for the pullback is discretionary. He means the size of the pullback we're waiting for and what we're judging to be a pullback. That's what you mean. That's what Dean meant. All right, change of gears. Momentum indicators. Okay, this is going to get a little bit technical for some people, but part of the problem with momentum indicators is that they're very sensitive, of course, to the periodicity that you put in them. If you use a 9-period stochastic versus a 21, a 34, or 55, you're going to get different results. And the reason you're going to get different results is that different indicator periodicities are going to work differently depending on market conditions. For example, if you have an oscillating market that's going up and down, up and down, up and down, a short, let's say a 9-period stochastic, is going to work better for you. If you have a trending market where you don't want to be particularly sensitive to every little swing, a longer one's going to work better for you. So if you really want to use the stochastic, you're going to be constantly fiddling with the periodicity. The other thing that makes a difference is that a change in volatility, let's say the market's rising slowly and then begins to rise more quickly, your indicator is going to be very sensitive to the initial rise in volatility. It's going to look like maybe it's overbought or oversold when that happens. So you have two challenges with traditional momentum indicators in that they have a very difficult time, even with some of the new adaptive indicators, adjusting to different cycle lengths in the market, and they don't adjust for volatility. So I wanted to come up with an indicator that adjusted for both cycle length and for volatility. Now, let's just step back a little bit and look at the bell curve. The further that a particular observation is from the mean, okay, bell curves, normal distributions are characteristic of random markets. The further a particular observation is from the mean, the more likely it is that it didn't take place on a random basis. Volatility and market behavior in generally is log normally distributed, okay? Which means that on a logarithmic basis, it's normally distributed. Okay, that was a lot, but for any of you who have studied what volatility is, we'll kind of follow what I'm saying, because volatility is based on a logarithmic rate of change. Volatility is one standard deviation of a logarithmic rate of change. So if you look at how much the market has moved relative to volatility, you're going to get a real clear statistical picture of how non-random a particular price is relative to what would be expected in a purely random market. Okay, so that said, we have two indices. We call the Kase serial dependency indices, up and then down. So the up index looks at the logarithm of the high today versus the low n days ago. So we're looking at, over n days, how much did the market move up from the low n days ago to the high today, divided by the volatility. So what we're really getting is the number of standard deviations based on volatility the market has moved. And the same thing with the KSDI down, but it's just flipped around. It's the low today divided by the logarithm of the low today divided by the high n days ago. So again, the result is actually a measure of how many standard deviations the market has moved. And we'll do that over a short number of bars. Let's say 8. We'll do it at 8 bars, 9 bars, 10 bars, 11 bars, 12 bars, 13 bars, all the way up to, let's say, 65 bars. And it will give us whichever serial dependency index is highest. So if we're on a 55 bar look back up, you get the highest number, that's the one you're going to use. On an 8 bar look back down, you get the highest number, that's what you're going to use. So what does all that mean? What all that means is, whatever cycle length is most trendy, the computer automatically uses that cycle length. And by definition, because of volatility in the denominator, it automatically not only adjusts the cycle length, but for volatility. So basically, the peak oscillator is just a smoothed oscillator of the Kase serial dependency up minus the Kase serial dependency down, whatever the maximum values of those were, over a particular range, just smoothed by a couple of bars. Most of you know that the MACD is to a simple oscillator, is the first derivative of a simple oscillator. The MACD is a simple exponential moving average oscillator minus its own average. So similarly, the KCD is the peak oscillator minus its own average. So that's all the mathematics and the philosophy behind all of this. And it's all well and good to have a lot of fancy math, but as we'll see, there are really remarkable differences between the performance of the statistical indicators here and the traditional indicators. We're going to take a look at that in a little bit.
Okay, so this shows an example of the KCD. This is versus the MACD. The KCD is the indicator on top, the MACD on bottom. The KCD is plotted as a green histogram. The red dots at the peaks of the histogram indicate shifts in momentum, and these are our measuring points. This is how we tell whether or not momentum is changing. In this case, we see falling price with rising momentum on the KCD indicator, which indicates a divergence. This is an indication that the market's going to turn or may turn to the upside. That's what it does. On the MACD, the market or the momentum of the MACD just continued to fall. So we had declining momentum with declining price. In this case, the MACD missed that divergence and missed that turn. On the next slide, this is Intel. Wanted to show some stuff aside from commodities. The Kase indicators do work well with equities as well. In this case, we have Intel on a daily chart. This is with the Kase PeakOscillator and a slow stochastic. The Kase PeakOscillator is on top. This is an indicator. Again, it's plotted as a green histogram. In this case, the black lines, the darker black lines, show shifts in momentum. And then there's a blue and a red line called the peak min and peak max line. In this chart, they're fairly close, but the peak min and peak max line, the peaks, okay, in this case wants me to show where the peaks are. The peaks are these black lines here. So we have peaks here.
I'm just sending little chat messages to everybody, Dean, just to kind of round out what you're saying. So you don't have to read what I'm saying. I'm just kind of sending stuff out to the whole group.
Sounds good. In this case, the peak min and the peak max line are the blue and the red lines. We'll show other examples of the peak oscillator so you can see those a little bit clearer. One is always fixed at 100. The other is 2 standard deviations. Whenever the momentum moves above the peak min line and stays within the bounds of the peak max line, we get an overbought signal, what we call a peak out, called a peak out global, or excuse me, peak out local. And a green PL will be drawn on the screen. Again, we'll see examples of this. If the momentum moves above both the peak min and the peak max, then we get what was called a peak out global. These are just different variations of overbought and oversold signals. They are better than normal overbought and oversold signals in the sense that, as we all know, once the market moves into overbought, oversold, it can remain there for a very long period of time. In this case, we wait for the peaks in momentum, the black lines, that correspond with the peak in price. So again, I'll show some examples of peak out locals and peak out globals in just a little bit. On this chart here, though, we have rising price with falling momentum on the peak oscillator, showing us a divergence, in this case a negative divergence or bearish divergence, indicating that the market could turn to the downside, and that was the case. On the stochastic, the market was, or the momentum was rising. So this did not, the stochastic missed that divergence.
Okay, just for anybody, by the way, who thanks, Dean. Just for anybody who liked my book, log on to Amazon.com and give me a good review. I always get bad reviews from people that don't know how to trade or don't, whatever. So if you like my book, give me a good review. I'll be very happy with that. Okay, on to a new subject. Everybody ready? Don't worry, we're going to pull it all together when we do the trade, explanations at the end. All right, again, how do you let profits run and cut losses? Well, if you're a baby trader, people will tell you to use a fixed value trailing stop. And the problem with using a fixed value trailing stop is the market doesn't care where you arbitrarily put this fixed value. Okay, and so you might think about using something like the true range. You might think about using something like the true range, which I did years and years ago. There were problems with using an average true range with the multiple that we'll discuss in a minute. The other one that I kind of liked 20 years ago was the parabolic. But just like the stochastic, you have to keep adjusting a parabolic as you're trading. So I wanted to find something that would adjust automatically to market conditions and would let profits run losses. So what I did is I used a true range, but not a fixed multiple of true range. And okay, technical stuff. Everybody might know what the true range is. The high minus the previous close, whichever's greater. That's a true range. What we actually use is a double true range, but that's just using 2 bars, range of 2 bars. But the little charts on the left really encapsulate what the problem is with using a fixed multiple times the average. In the upper chart, you can see we have a large variation around the mean. In the lower chart, a small variation around the mean. Yeah, these are Gaussian or bell curves, or whatever you want to call them, normal distributions. But on the right, you can see the actual real distribution. We're going to talk about that in a minute. So the point is, if you have a market where all the bars are about the same size, which would be the bottom chart, you can put a stop that's a fixed multiple of the true range. You're not going to run into trouble. But you can have a market like the top one, where the average is the same, but you get some really tiny bars, you get some really huge bars, and in order to stay in the trade, you've got to stay in through at least some of the huge bars. Let's say you want to stay in for 95% of all the bars, and only get out if you have a move that's in the top 5%. And so you have to take into consideration the variability of the true range. Bottom line is the standard deviation of the true range. So we wanted to use not a multiple times the average of the true range, but so many standard deviations above the average true range. So we set our stops at 1, 2.2, and 3.6 standard deviations over the average true range as our stop levels, and that accounts for a variability in the volatility in the true range sizes, and secondarily the right-hand skew, because true range is skewed to the right. You see, if we had a two-way conversation here, I'd ask you all why it's skewed to the right. But the reason is the smallest bar can have a zero range, but the largest bar could theoretically have an infinite range. So that skews the curve to the right. And so the 2.2 and the 3.6, instead of 2 standard deviations and 3 standard deviations, are correction factors to account for the skew of the true range. This is a pretty, but it gives stop if stop is hit. So if the warning line is hit, which is the average true range, there's a 79% chance of hitting stop 1, 61% chance of hitting stop 2, way down. If you actually hit stop 1, then there's a 77% chance of hitting stop 2, etc. So, and then the bottom chart is closing beyond one stop. What's the probability of closing beyond the next stop? So you not only have stops, which allow your profit to run and can cut your losses, but you also can have some guidance as to what the probability is of it moving to a certain price level, right? Each stop is associated with a particular price level. So you can have some idea of how much risk you're taking and what the probability is to hit the next stop.
Chart here again shows the euro US dollar on a daily chart with the Kase DevStops applied against it. Now, one of the factors in the Kase DevStops is we're looking at, like we talked, double bar true range over a period of time. We're looking at standard deviations 1, 2.2, and 3.6 away from the mean, and we're either adding those to a low or subtracting those from a high. But to keep it simple, so that we don't have stops all over the place on the chart, and to keep the chart readable, we use a simple 10 and 21 period moving average crossover to decide whether or not we're plotting long stops below the market or short stops above the market. So in this example, we show the market's falling, most likely would have been short, so we have short stops that are plotted above the market. The red line is what we call the warning line. This is the average or the mean, the 50th percentile of the bell curve, the true range that we're looking at of the distribution. And then you have Dev 1, Dev 2, and Dev 3, which again were the 1, 2.2, and 3.6 standard deviations. When the 10 and 21 period moving crossover takes place, the stops flip from short to long stops. So now the stops are plotted below the market. So as the market's rising, we see that we have the short stops. Now, one of the great things about the indicator, and it's you can kind of see it on this chart, is as the volatility of the market increases, your stops become wider. And as the volatility decreases, your stops become narrower, so that if there's a breakout move against your position, you get stopped out sooner. Now, the stops may not always be flipped direction that somebody wants, so you can accelerate and decelerate the stops by changing a variable in the indicator, the 10 and 21 period moving average, what we're going to show here, where we accelerate the stops using a 5-13 period moving average, overtakes in this case, and then we have flip overs here. Now, some short stop, long stop, and so that's why 10 and 21 we use as a default. It seems to work fairly well, but again, this is something that you can work with and play with a little bit in the variables of the indicators. If you want to decelerate the stop, you might use something like a 13 and a 34. Generally speaking, as you can tell, well, for in the case here, the stops flipped much earlier. In this, well, actually, the flip took place much later, and then here the flip takes place again on a later basis. So these stops flipped a little bit slower. I'll go ahead and turn it back over to Ms. Kase here.
Digress, but somebody asked me what volatility is. Any textbook will tell you that volatility is the standard deviation of the logarithmic rate of change. If you're trading a market and somebody says the volatility is 40% or 80% or whatever, it's been annualized, and basically what they do is they take that standard deviation of the logarithmic rate of change and they multiply it by the square root of the number of trading days in the year. True range over reasonably short periods of time, 30 days, 60 days, whatever, is directly proportional to volatility. We use the logarithmic rate of change for the momentum indicators, and we use a regular linear true range for the DevStops. I looked at using a logarithmic volatility for the DevStops, but it just seemed to work better with linear. Let's see, could the DevStop also be used for profit targets? Well, you've got the probability of it hitting a particular price level, so you can estimate how far the market's going to move based on the DevStops. So when you say profit targets, I prefer to use the term, can you forecast using the DevStop? And the answer is yes. How well do the indicators predict turns? This slide I'm going to go over very quickly. The indicators predict turns all about the same. So I call this, in this particular direction, how well an indicator predicts that a turn's going to follow. It's pretty much the same. That the warning line will be hit ranges from about 80% to 90%, depending on what indicator you're looking at. So you could say, well, what's the value in the case indicators if they all predict, if you get an RSI and it turns 90% of the time? So the answer, Dean, can you move your little red dot? The answer is in this slide, is that in one direction, all the indicators work the same. But if you ask how often do the traditional indicators catch turns, how often do the case indicators catch turns, there's almost no comparison. The standard indicators catch turns about half the time. So even though when they do trigger, they almost give no false positives, you almost always get follow through, you get a lot of turns they miss, where the case indicators catch 80% of the small turns. And what we're saying, small turns, that if the market only turns and hits Dev 1, the first standard deviation turn, 80% of those turns case indicators are going to catch. Only 50% of them the other indicators are going to catch, which is a 40% improvement with the case indicators. And that's why the broccoli is there. It's not that bad to have to eat broccoli, but this is like the cockroach one, is that big turns, Kase has a 50% improvement in that if you look at the big turns, the degree to which the traditional indicators catch the big turns is about 47 maybe percent, and the case indicator is about 82%. So if you ask, why bother with all this math? What's the good of using more statistically rigorous indicators? The answer is they catch a much greater degree of the market turns. So if you're looking to get out of a trade, to not give back a lot of profit, it's very valuable to know the market is going to turn before you hit your stops, right? In other words, you can have stops. Stops are great. I always recommend trading with a stop. DevStops to let your profit run and cut your losses. But if you can get out 1 bar off the high or 1 bar off the low, that is preferable to waiting until your stops get hit. And so what you're going to do with the traditional indicators, half the time, maybe 55% of the 55% of the time, you're going to miss the turn and hit the stops. With the Kase indicators, that's only going to happen between 18 and 20% of the time. The rest of the time, you're going to be able to get out a bar or so off the bottom, bar or so off the top. And now Dean's going to walk you through, and I just would encourage everybody to pay attention because examples and should really illustrate how the system works.
Okay, so we're going to look at a simple example here, and one of the premises behind using Kase StatWare is we recommend using multiple time frames. We usually set up 3 time frames, each 3 times greater than the other. So if you had a 15-minute as your lowest, you might use a 15, a 45, and then what is 45? See my math skills here.
30-minute or 2 hours, something like that.
Yeah, something like that. So that's what we're going to look at here. And this right now, we're calling this 15-minute chart what we call the timing chart. This is on the S&P E-mini. The first signal, or number 1, shows us a third-class sell signal. Now, right after that, there's a first-class buy signal. So we're looking both long and short, but we're waiting for a pullback in one direction or the other, and then our second signal. The market continues lower and begins to pull back. Now, while it's pulling back, we start to get long signals again, but we had taken out the low of the bar from the first class signal. So we're no longer looking long, and we do not have a pullback here where the second class signals took place.
Can you use your cursor?
Okay, I'm pulling up the little red dot again. Here's a little red dot. So here is the, sorry, I didn't know it was not showing the cursor. Here it shows 2 signals, 2 long signals, but there was no pullback between. Now we still have that valid first short signal from here, where the number 1 was. We haven't taken previous swing high. So when we get this third signal, it's the second signal, we can go short. We now go short. The market doesn't, this chart, for example purposes, does not show the dev stops, but at that time, when we entered short, we would have placed a stop at dev 3. That way, if the market turned around and hit dev 3 without warning, we'd be stopped out of our trade without losing too much. In case the market does continue down, at point number 4, and we'll see this clear on the next chart, we would have scaled our trade up to the next time frame, in this case 45-minute chart, 3 times higher. And that's because we're getting a sell signal. I'll show that in just a second. The reason I'm not switching yet is I do want to show an example that if we did not scale our trade up, the market would have fallen. We would have had a successful short trade, where at point number 5 we get a KCD divergence, falling price with rising momentum. Momentum is rising here. And we could have exited our position. But by using a higher time frame filter, if we look at the 45-minute chart, at point number 4 we get a third class sell signal. We would have been able to scale our trade up to the 45-minute chart, and at that point put our dev stop at dev 3 on the based upon the 45-minute chart. The higher the time frame we trade, or the higher the time frame we're filtering, risk we're going to take, so the dev stop 3 will be. The market then begins to fall again. For 6, that's where we would have taken our exit on the fast monitor on the 15-minute chart. In this case, we don't see any signals, so we would have been able to stay in trade all the way until point 7, a KCD divergence, falling price with rising momentum, as well as a peak out global. I did probably see a peak out global. In this case, see that the histogram on the peak oscillator that's on the bottom, the momentum, the black line, fell below both the blue and the red lines, indicating that it was oversold. Curves that confirms the divergence signal, and we're able to exit our trade. We could exit this position in two phases, meaning that we could pull out of 80 our position. Since about 80% of the time we go on to hit warning signals or the warning line, we could pull out 80% of our position, keep 20% on, and pull our stop from Dev 3 to Dev 1. In that case, the next hit Dev 1, and we would have exited remaining 20%. I'm going to go ahead and move on to the next. In this case, we're going to use another higher time frame. We're going to use all the way up to. In this case, we get a third class signal. That's our first signal. The market begins to pull back. Well, the pullback previous swing. So that first signal, even though it was a third class, is no longer valid. We are now neutral, so to speak. The market then falls, and at point number 3, we get a first class sell signal. The market back. During the pullback, we do get some long signals, but we didn't have any pullback or short pullback. We hold and the market falls. We get our second sell signal, another first short at point number 5, and we enter the market short. We place a stop at Dev 3 based upon the 180-minute chart, and at point number 6, as we can see on our next chart, 140-minute chart filtered on the higher time places our trade place, so to speak, minute chart. At point 7, our trade. I'm not going to quite show that yet because I do want to show the market would have fallen. You get a Kase peak and a peak out. You'll notice on the KCD chart that the green has turned to pink. This means that it has entered into an overstory and gives us the red KCD indicating that there was a change in direction. So we have the KCD peak. Local also occurred. We cannot see that because our notes are lying that. But if you were to look at the chart, you would see a peak out local where the momentum moved beyond the blue line but stayed in the brown red line. At that point, there would have been an exit on this 540-minute chart. Even if we had exit and let the market turn, we would have hit Dev 3 and would have been stopped out at Dev 3. So in either case, on the 540-minute chart, it would have still been a successful trade, but we would have given up the gains by not rolling to the daily chart like we do here. The daily chart, we get a third-class sell signal. The chart here at point 8, where we had seen Dev 3 being taken out before, we hold just play, and the market begins to fall in. At that point, a KCD divergence with a peak out global again, and we're able to exit our trade. Again, we can take a 80% exit, or if we take the 80% exit to Dev 1, which gets hits 2 bars. The point of exiting in phases is that sometimes there are some false positives as far as the divergent signals or peak out signals. So if you exit and pull your stop level in, you're taking less risk. It does get hit, you get stopped out. Otherwise, it continues lower. In this case, like if the market didn't hit Dev 1 and continued lower and took out this swing low, well, then we can get back in short. We're still short 20% from our original entry point. And this case does make a good point there in the chat box that 20% of the time are live, so we leave 20% in place and exiting 80% of the time. And I just want to see if there was any other questions here.
Well, I'm going to go ahead and see if I can get this question to everybody. So while we're wrapping up, people can... Did everybody get the question, the polling question? I guess, well, yes, I guess everybody did. Well, this concludes our seminar. Hey, we're right at 5:30. I appreciate everybody attending. As you may or may not know, we do offer, in addition to the fully functional trial, and this is kind of a freebie for y'all because often we charge for our trials. But in addition, if you want a lesson, Dean, what are we giving for lessons? Half an hour lesson?
It is a half-hour lesson.
Okay, so we give it a half-an-hour lesson, or you can sign up for a couple of half-an-hour lessons if you want some individual coaching. So in any case, we're offering the free trials. Our website has the ability to sign up for reprints after reprints of almost everything I've ever written. And also, if you are interested in any of our upcoming classes, please let us know. We're in Santa Fe, New Mexico. We're probably going to have a class sometime in the spring or summer. So in any case, the indicators work on any bar where there's an open, high, low, and a close. And the software, I think we're pricing it at $195 a month. And that's and I don't think you need to read my book before using the indicators, but I would recommend reading the manual before using the indicators. I think the book is helpful for people who want all the theory and mathematics behind them. But just like you don't have to learn how a car is built in order to drive a car, I don't think you need to read my book to use the indicators. But I would recommend reading the manual. So again, any bar that has an open, high, low, and close, you can use the indicators with. And let me just see if they're